Hello, everyone, and welcome to Analyzing Finance with Nick. In this episode, I'm going to be answering a viewer question on how to value cyclical stocks. Cyclical stocks, really just for lack of a better term, are companies that are in sectors that are more economically sensitive than either defensive companies or just general firms that have a more stable source of demand. Like the classic example of a cyclical stock would be an automaker. Due to high fixed costs in terms of operating factories and union wages for the auto companies that still have those, and other variables that are just that you have to spend no matter how much the demand for cars are, means that during lean years the profits are not very high or they're outright losses, and whereas in good years the costs don't go up that very much because most of their expenses are fixed, so therefore all of the extra sales demand goes to profit. And so as a result, they have way more choppy earnings than a more perennial demand type company. Say Google or a tech company, for example, which the demand for consuming technology products is less economically based and more consistent. I mean, all companies are somewhat correlated to economic performance, but cyclical companies are of much more magnitude due to the fact that their costs are mostly fixed and the variable costs for producing additional products are low. The market tends to prefer companies that have more predictable cash flows and are more consistent across a cycle. Therefore, cyclical companies tend to command an overall lower valuation. But on the other side, cyclical companies are more predictable than companies that just have erratic performance, that just have one good quarter and then one bad quarter with really, and it come in random elements with really no sort of predictability. So as a result, because of this, cyclical companies are valued quite differently. For example, during the peak of a cycle, a cyclical company will often have a low PE and not a high PE. That's because, say for example, if it's a car company, the average cyclically adjusted earnings of the car company are $10 a share. And so it trades historically at a PE of 10, just to make the example easy. And so let's just say the economy's great and we're at peak cycle, and this car company earned $20 a share, but it's still only trading at $100, which is a P of 5. Why? Because the market's anticipating that earnings will go back down to the cyclical average when the cycle cools off. And so as a result, if you are going to buy it, this is not necessarily a good deal, even though 5P on a normal basis is considered cheap. It's only a good deal as if you think that there is a new structural source of demand for the cyclical product, or if you think the cycle highs can exceed those of the last cycle, and let's say you can have the earnings go up from say $20 a share, which is the previous cycle peak, to maybe say 25, and the stock should gain from that even at the discounted PE. On the other hand, say you have a recession and the same car company's earnings fall from $20 a share in good times to $5 a share, which is half the cyclical average in bad times. So then, because let's say the stock still trades at about $100, and it's the PE, or actually falls a little bit, let's say it falls to 75. It's trading at a PE of now 15, which is higher than what it was at the peak of the cycle. But it's actually a much better value proposition than it would be it was at the peak. Why? Because the market this is the cyclical trough, and the market expects the earnings to correct to normal. So if it goes back to 10, which is the historical average, and has the same historical average valuation, even if it's lower than the current PE, it's back down to 10, stock should appreciate 33% and get back to $100. So this is how you would value cyclical companies. You buy when the PE is high, you sell when the PE is low, assuming you're at the right stage of the cycle. So the difference is you got to analyze the demand cycle. And these are not necessarily correlated. They're mostly correlated to the business cycle, but sometimes they're not. Like the aerospace development cycle often is different because the main drivers for aerospace demand is a lot of it is military, which is not tied to the overall military spending. It's more tied to political factors and geopolitical ones, and not necessarily the regular business cycle. But for most, it's tied to the regular business cycle. So you got to look at where we're at the business cycle, what is the cyclically adjusted earnings over a period of time, and maybe have to factor in an inflation adjustment too, because these things tend to be sine curves, but upper trending sine curves due to the impact of inflation on earnings in the long run. And then figure out where we're at. So that what is the valuation adjusted for cycle? So you want to instead of using the regular E or the current earnings for your valuation metric, you want to use cyclically adjusted earnings, and that is how you would value cyclical companies. Overall, it seems a little bit counterintuitive when you first look at it, but when you factor in a more predictable cyclical volatility of earnings, it makes a lot more sense. Thank you again for watching. If you like what we're doing, please subscribe to the show and ask any questions you have. You can email us, or you can comment directly on the comments of this channel. Thanks for watching, and good luck out there in the markets.